Hello everyone, welcome to today's class. Of course, you're hearing the voice of Emeka Onyeneke, founder and CEO, Active Arc and FinFast Group Solutions. This is a continuation of our previous classes on account classification and the basic principle or the double principle of bookkeeping. We had promised in our previous classes that we are going to end that series with a very practical question so as to further enhance the understanding of those basic principles. So here we are with a very deep practical questions that will highlight some of those things that we have discussed earlier. So here we have below is from the books of Ajumama's Fashion Boutique for the month ended 31st March 2025. First March invested 50,000 naira cash into the business. Second March purchased inventory for 10,000 naira in cash. 5th of March purchased furniture for 5,000 naira on credit. The 10th of March sold goods for 15,000 naira cash, and then the cost of that goods was 6,000. 15th of March paid 2,000 for rent, and the 20th paid 3,000 naira to supplier for furniture, and 25th of March received 5,000 naira from a customer for services rendered, and on the 31st paid salary of 2,500. So we are required to prepare journal entries, transfer to ledger, prepare income statement, and then prepare balance sheet. So this is a very comprehensive question that will illustrate how we start preparation of an account from the very basic, from the book of original entry, which is the journal, down to the ledger, income statement, and then balance sheet. So let's dive into it. Step 1, which is the requirement number 1, journal entries. Remember, we have said that we have the guiding principles for preparing any financial transaction, which includes that 1, there must be 2 folds of account in every single transaction. That is 1. 2, that there must be the receiving and the giving account, which must be debited and be credited. So identifying these 2 things are key to being able to know how to post each transaction. So let's take them one after the other. The first transaction is the investment of 50,000 naira into the business with cash. Now, this is a single transaction, and there are 2 folds of accounts. One is cash, the other one is capital. When you start a business, the money you introduce into the business from the beginning is called capital, startup capital. Okay, so that's one leg of the account. The second leg of account is the fact that this money that was introduced is cash, is in cash, 50,000 naira. So what this means is that the receiving account is cash, while the giving account is capital. So we debit the receiver and credit the giver, which is cash is debited here and capital credited. We can see this here. can see this. This is cash being debited here and capital credited, cash invested into the business. Remember, we have a column here, the debit, and the credit. Okay, we'll go to the next one. The next one is purchase of goods in cash. Purchase of goods in cash. This is also a two fold account here. The accounts involved is purchase and cash. Purchases and cash. These are the two accounts here. Now, purchases is receiving and cash is giving, because the purchase is receiving the goods and cash is paying for the goods. So we are debiting purchases with the sum of 10,000 naira and crediting cash with the sum of 10,000 naira as well. Then on the 5th of March, we have purchase or bought furniture on credit. Now the business owner bought a furniture on credit with the amount in the tune of 5,000 naira. He bought it from a supplier or the furniture maker, name not mentioned. So in this case now, the two accounts are the furniture account and the account payable or the supplier's account. Assuming the furniture maker or the supplier in this case was mentioned, that name will be the name we have here, but it's not mentioned, so we have accounts payable. Accounts payable are those we are owing, because this was a credit transaction, furniture on credit. Okay, so, and in this case, furniture is the receiver, the supplier or the account payable is a giver. So we are debiting furniture and crediting the account payable with a sum of 5,000 naira. On the 10th of March, we also have a goose worth 15,000 naira sold in cash. Goods worth 15,000 naira sold in cash. So cash is receiving and sales or revenue, sales revenue is given. So in this case now, we are debiting cash with the sum of 15,000 naira and crediting sales with the sum of 15,000 naira. Then the accompanying cost of sales for that particular sales. Remember, the sales it was mentioned that the goods were sold for 15,000 naira and that the cost of goods sold of that same goods is 6,000 naira. So in this case, 6,000 naira is to be debited to cost of sales or cost of goods sold, and then inventory, because when you sell goods, inventory is going out and then the cost of sales is being debited because as an expenses. Okay, the cost of what was sold has to be debited and then the inventory that is reducing has to be credited. Then on the 15th, there was a payment of rent in cash also, and this is to the tune of 2,000 naira. So in this case, rent is receiving and cash is given, cash is going out. So rent account or rent expenses is debited and cash is credited. The next is March 20th. So 3,000 naira was paid to the furniture supplier, the person who the owner of the business bought furniture from on credit, remember, to the tune of 5,000 naira. Now a part payment has been made of 3,000 naira. So in this case now, the reverse will be the case. We are now going to debit the account payable or the account of the furniture supplier with 3,000 naira and credit the sum of 3,000 naira also, which is cash also. In this case, as cash account. The next is on the 25th, cash for service rendered. Now the owner who rendered the service, he does not only trade, So he also renders services. So he also receives the sum of 5,000 naira as cash for services rendered. So in this case, cash is debited just like sales. Remember, this is part of sales. They are the same. So cash is debited and revenue or sales is also credited. And then finally, on the 31st, 2,500 worth of salary was paid. So the owner paid his or her staff, and that what that is we have salary account and the cash account. So the salary is debited, it's an expense, and then cash is credited. So we have seen the step-by-step way of making the journal. In this journal now, what this means is that the account, whatever account you're going to prepare now, will have to must balance. With journal, you have already gotten it right, having debited the right transactions and created the right transaction. If you take a total of both sides now, the debit side and the credit side, you will see that they are going to give you the same figure. So this has complied with the principle of every debit entry must have a corresponding credit entry. Okay, you can see now that all the debit entries are having corresponding credit entries. Okay, so this is the principle which has been applied here and complied with. So the preparing the other aspect of the account will be that easy. So going forward to the ledger account posting, what this means is that all the debit side will be debited into the ledger, and all the credit side will have a credit entry into the ledger, so that we'll have the same situation. So let's go to the debit now, the ledger now, which is step 2. We now post to the ledger. We have tried to take the T format here to simplify the understanding of the ledger. This is the T format of the ledger. Okay, it can be done in a vertical form, whereby everything on the debit is a plus and everything on the credit will be a minus. At the end of the difference is this balance in rent ache that you are seeing here, and then the account is balanced off. Whatever you have on the debit, if you have a balance carried forward or balance brought forward, that is the that is the balance of that particular account. This is balance brought forward. Okay, the balance of such an account. And we also have tried to identify the nature of account, like we had in our account classification, ledger account classification. So this is also being applied here. The cash account, which is the first ledger account we are opening, is a real account. Remember, we said every real account are debit accounts, which include the assets and the expenses account. Okay, so this is assets, a current asset, so to say, is a debit balance. That's why we're bringing every transaction to the debit, and then all the transactions that are expended or that goes out of cash are credited. Now, the first transaction was the fact that 50,000 naira capital was introduced. So this is the cash receiving the 50,000 naira. Okay, the cash account receiving the 50,000 naira, and in form of what? Capital. And then the cash account also received the sum of 15,000 naira and 5,000 naira sales. Remember, in the journal we had 15,000 naira sales for goods, and then 5,000 naira sales for services rendered. So put the both of them put together give us the sum of 20,000 naira. All this will be on the debit side because the cash account are receiving these funds. It's a receiving account, so they must be debited. And then you now have total 70,000. Now when you now go to the credit side, which is the minus side, so to say, if you are preparing it on a vertical form, purchase of goods in cash, so cash is going out, so we're minusing